All in favor? Approved. I guess 2014.
Did I forget that?
Another thing, and I don't know if it's another thing, we're looking at ways to increase revenue. One of the things we're looking at right now is a special census, and you know, the per capita increase on it would give us about, if granted, I got some estimates in from the state on what per capita portion of the state shared would be, and based on if we had a $9,000 population, we would get about a $100,000 increase annually on our general fund revenue, and we would get about a $26,000 increase on our state street aid revenue. So now that's based on a 9,000. Of course, we have to see how much it would cost to do it and what we'd have to do, but that's a substantial amount of money if we are actually there. We may want to wait. I don't think we want to wait to 2020. I guess is my point. I think sometime within the next year or two, probably need to do that.
It hasn't been that long, I don't think, since we did one.
I think 2010.
Yes. But I'm talking about the special. Didn't we do one? But 2010 was the real one.
I don't think there's been one since 2010, to my knowledge.
I don't. We did one either right before we came into office or right after we came into office. No.
The cost estimate dollar on it was about $30,000.
It's a fairly significant.
I'm pretty confident we'll make that $9,000.
Fairly significant.
In July this coming year, we've got these.
Well, that'd be something that I'd like to have some significant firm data on, and maybe we can present something with the budget numbers this next fiscal year.
I don't need for you to go through it.
Okay.
Any other questions on the finance report? Item 6, old business. Old business. Item A, discuss and or take action on health insurance recommendations.
Shannon, you want one of these? It says recommendation. I'm not really here to make a recommendation. I think that's something we have to discuss, and it's probably going to need to be discussed and concluded with the Board of Commissioners as a whole. But I did want to talk about a little bit about all the research that I've done, and I only researched with Tim White. I did not contact any other people. I was waiting to hear for our reschedule with the other gentleman that Tom and I were going to talk with. But there were a couple of things that, as I researched other cities' programs, that jumped out that are not currently part of our policy, but it is the way other people seem to do the business. The first one is that now the county allows their people to do it, but most of the other cities, the elected officials don't participate unless their spouse is a city employee and they participate off of their spouse's program. Program coverage, we seem to be one of the few cities that don't offer an extended program for those folks that retire with full benefits here. To cover the gap between age 62 or 60 and when they go, and that's something that I think we need to consider. And then a lot of places, if their spouse has health insurance or can get health insurance through their employees, through their employer, then they're not allowed to be covered at all. And I kind of have a halfway opinion about that. I don't think that if you can buy better insurance, if we're offering a better plan and they want to pay the premiums, I don't really have any problem with covering a spouse. Even if they have health insurance offered at some other place. But if they get in the same exact coverage, then it doesn't really make any difference. I mean, it really hurts the city to have to pay for that. So that could be a very complicated process to try to figure all that out. So those are just things to talk about. I looked at 4 policies in addition to the one that we currently have. Now, I promised Tim that I would caution everybody that the numbers that I am using here are as of, the time he gave me the quotes. As y'all all know, it changes based upon our participation, the number of claims, all that stuff. So at the time we go to renew, then they will issue us a new actual cost. But based on what we've seen so far, and I didn't make y'all a copy of that sheet. Kent sent me that data like he did last year, and I'm uncomfortable with that data, so I shredded it. I don't. Who's making claims and who doesn't make claims and how much is not something I want to know. But we're running about the same, so hopefully it would stay about the same. Now, the basic is our current policy, and that keeps us in this HRA business. Personally, that's something that I don't like because it's a contingent liability. And while we can budget, what we've done is we've budgeted $75,000, and I don't think we're there yet. But the bottom line is we have 60 employees. If they all participate in the health insurance program and we all guarantee them we have a contingent liability of $120,000. So I didn't, only Brentwood continues to have an HRA program, and that was because it was funded many years ago, and employees contribute to that. So it almost operates like a health savings account. So I mainly focused on developing choices of insurance based upon how high deductible they wanted, how many people were in their family, and how much they wanted to pay each month. And I did it by pay period because I think that's the way we withdraw, is every pay period. We don't withdraw by the month from them, we withdraw by the pay period. So as you can see, the insurance is, you can get a very low deductible, which is $1,000, and a $2,000 maximum out of pocket, but you're going to pay for it. It's going to cost you $202. If you have a family coverage, it's going to cost you $202 per pay period in order to get that coverage. So what it does is it allows folks to pick a policy that fits their needs rather than have one standard policy for everybody. If a single individual who's in good health, doesn't have any dependents, doesn't know of any health problems or anything, if they want to pay, have a $3,000 deductible and a $6,000 maximum out of pocket, their cost is basically $27 a pay period. Pretty inexpensive stuff. But again, if you've got somebody that has a severe condition and or have, for instance, a diabetic that is on insulin, you're going to equal that. There's the chance that they're going to go up. Then they may want to buy the best plan or the super plan, depending upon where they are. For me, if I was a city employee, the plan I would buy would be the best plan, which pretty much covers everything, after you get to the $1,000 deductible. You start paying, they start paying 70%. It puts back in a better prescription drug. You have co-insurance, you have 100% well care. You go to the doctor, you pay like $25 for an office visit, somewhere between 20 and 30, depending upon what our rate is. Specialist will be a little more, but if you go to the emergency room, it's gonna cost you $250. Anyway, it lets people choose what they want, and it gets us out of the HRA business. And so my only recommendation is that we look at providing this policy rather than the current, another policy like the current ones we've been providing, and get out of the HRA business. Now, I used $450,000, and here's the way I came up with $450,000. $350,000 plus the 120 potential liability is 470. The 75 we have budgeted is 425. Halfway in between is $450,000. That's how I came up with $450,000. If you, for each $10,000 in funding from 450 down, I don't figure we're going to go up, so I figure if we go anywhere, we'll go down. You see a $2, $4, and $6 increase per pay period per employee, depending on what their plan is. So if just to illustrate, if I'm taking the super duper policy and I'm paying $202 per pay period, then, and we only funded at $420,000, then that's going to be, my cost is going to go up to $220 per period. So that's just to give you an idea as to how. But my recommendation is that we move away from a HRA and do this type of policy, and I think it is within the ballpark. We just have to look at the numbers and see how much we can afford to fund.
Is that 450, is that a net number? Is that taken into consideration, these contributions going into the whole cost of the insurance?
No,
This
that is the city paying $37,500 per month.
Okay.
Toward the health
Would
toward the health insurance.
would that be what they would bill us? The insurance company would bill
No,
us?
they're gonna bill us, those numbers, I left the quote sheets on here, Tom. Mm-hmm. They're going to build, you can see on Plan A, they're gonna build you, it tells you 45.9. And it goes up from that point. Each one goes up 45.9, 55, 55.3, and 57.178. And this was no change to the other plan.
Okay.
I only worked on health insurance. So what the employee, that's how I took what we were putting in, subtracted the difference, and did it on a share basis. If I was single, I needed 1 share of insurance. If I was 1 + 1, I needed 2 shares. If I was family, I needed 3 shares. That's how the rates were established.
Okay.
But the things that I heard and the employees that I talked to were, they would rather pay higher premiums and have the insurance kick in earlier. They would rather put their money into premiums knowing they had better insurance. And even with the HRA, my biggest problem with the HRA is even though they do it, you know, we pay to have Blue Cross administer it, I still see that as an unfair benefit because, and not that anybody wants to be sick or anything, but you have some folks that we'll charge higher insurance for to be equal in what we charge people, yet they never use the HRA. And then you have others that use the maximum amount for, like I said, I don't think they're doing it purposely, they want it not to be said. It just seemed like we ought to put our money into providing lower cost deductible and that sort of thing, rather than on a reimbursement basis. And, you know, I looked at what, if we went out on the marketplace and bought it as a small business, and we're still getting a better rate than if we went out on the marketplace. Currently out there, based on this year. You know. But I think that's a good test to check things by. But what your check would be is that total monthly premium. But I capped us at 37.5. Now, like I said, you know, if we go down from 37.5, then their premium goes up, which may cause somebody that wanted super to only take the better insurance.
Right.
One of the complaints that was shared with me was that, you know, the prescription stuff. And so I tried to make sure we had a little better policy for that, on the prescriptions. Questions?
I'm with you on number 3. I think that would be hard to police. I think we'd probably have to come up with a policy or at least a system on how we would
Well, I put that on you.
get
CFO.
yeah.
But I don't, most of them don't, they just have a cut and dried thing that says, you know, if you're offered insurance, like, Starbucks was one of the private companies. If your spouse has insurance, Starbucks won't cover. You can't add them to your policy. The problem with that is that, I still believe we're providing a good insurance policy to our employees. And a lot of the other places out there have tailored back their insurance policies to be in line with healthcare minimums. And so you know, if they're willing to pay the premium, I guess it really, especially in a family environment, I mean, we've already charged them the max anyway. But I guess that would be something the board would have. The one that I really think we ought to do is if somebody retires after 20 years service and they're on full retirement, they should pay the full cost of their health insurance for 5 years that they.
I agree.
So I think that ought to be a kicker that we ought to consider. We don't have that many people that would be eligible anyway. Most of y'all, we got quite a ways to go.
Yes.
Any questions?
All 3, actually.
Brian, I would ask you to open it up in case any of the commissioners would have any questions.
No, absolutely. Any questions at all?
I don't think I'll ask any right now. I'll wait till the meeting.
Agree, okay.
Well, you know, it's hard for us for me to make I mean, this is, my recommendation to the Finance Committee is that when we're planning for the budget, that we look at providing one of those others rather than staying with the HRA. So, and that, I guess that'll filter up to the board through that process. So, I did not plan to bring it unless you think I should. Bring it to the boards right now to see what the board thinks. Because we don't have hard numbers. Won't have hard numbers
Till renewal time.
well, but till budget time.
Yeah.
And, you know, and if, we don't even know what our starting place is for that.
For the retirement, we're looking at somebody that's retiring at 60, then they would be eligible for Medicare at probably 65, 66, somewhere in that range.
65.
Yeah, so,
Medicare's going to kick in 65. So
we
the
would
maximum,
pay it, if they retired at 62, then we got 3 years.
right, the maximum we would pay would be 5. It would be 2. We have 2 people that are nearing that spot in their life.
Now, how would, I guess we'd have to set up a system how we would incur the their contribution, I guess we'll cross that bridge.
Yeah, we just have to, they'd have to either give you a check or something. You'd have to have a draft or something. I know with the lanes, they won't deduct it directly, but they will let her have an allotment, so she could send a check to here. Same program, it's all. All right.
B then, discuss or take action on pay plan
More
recommendations.
handouts for you guys. All right, Patty and I had discussed this, and so this is the sum total of the work. It's not really a recommendation, it's just where I think, going back and looking at my original notes and looking at some of the stuff, I think this has some merit that it ought to be considered. Right now, we don't have to do anything. Our system is working just fine. Evaluations are getting done. People are getting annual raises as they're supposed to. The promotions are working just fine. And we are living within our budget allocation for salaries. So everything is like that. But originally, we had talked about, when we first went to do this, we talked about staggering. Whereas both the federal and the state system, the longer you serve, the longer it is between raises. So that's what I first went into it to see about longevity pay, and to reinstitute longevity pay would cost us a lot of money. And within 3 or 4 years, we would be spending more money on longevity pay than we are on any of the current systems. So if we went to a staggered, which would be for the first 5 years, you would get an annual raise. From 6 through 11, you would get one every other year. And then from years 12 forward, you would get one every third year, with the base performance merit being a $2,000 raise. We do save money. We save approximately $20,000 a year going across the board in payroll costs. We basically spread it out. Now, every third year, you save a little less because you've got the 3-year people chipping in. But what it does allow us to do, and I don't remember whether it was Brian or Shannon, whoever made this, it does allow us to implement a above average performance raise. Whereas if you have somebody performing above average, you can give them an extra %. And you could also, adjust the successful merit raise down to 1.5%. That's what inflation has been running, has been about 1.5. So if you wanted to tie that to the inflation rate or whatever. Anyway, so most of the rest of the stuff stays the same. Now, when you go to a staggered system like this, unless you want to throw everybody off, because nobody will be on the current system of steps 1 through 20, you have to go to a range, saying this is the bottom part of the range, this is the top part of the range, and so as long as your new salary doesn't exceed the top, then it's just a calculated salary for you. So everybody still has a grade. However, nobody has a salary. It's not, you don't know what step they are. They just have a salary inside that range. So to give you a little about. Again, cost of living raises, if we choose to give them, are separate and distinct, and they basically just apply, not only do they apply to the employees, but they apply to the ratings. There were a couple of adjustments that needed to be made to the actual chart as to what grade things are in order to accommodate people's current salaries and look at equity in terms of their responsibilities and those sort of things. And I think I've talked about them before. A captain in the police department is not the same as a captain in the fire department. And that's, the captain in the fire department is the same as a sergeant in the police department. So I tried to you know, right all those wrongs and do all of that. The new pay ranges, I tried to use round numbers. I mean, I can go back and put the exact numbers, but I tried to use round numbers. This won't cause anybody to get a raise or anything like that. It's just so that you know the minimum and the maximum are essentially the same. And then the other chart on page toward the bottom there is just to show, you know, if on my date I have you know, 5-year service, then I won't get another raise till my 7th year, 9th year, 11th year, 14, 17, 20, 23, that sort of thing. Now, the last part is I would caution on distributing it because it has everybody's current salary based upon the information that they have. Tom, it may not be exactly right. So Tom would have to figure that out. But it also has an anniversary month. Now, some of these people have gotten promotions and their anniversary months have changed and stuff like that. One of the provisions is that if you've never been promoted, if you're still in the same job you were in, you've never been promoted, then your anniversary date is the date that your anniversary merit raise comes. If you get promoted, so you go from a 5 to a 6, then the date of your promotion becomes your anniversary date, so that everybody has to serve a year before they get a merit promotion or merit raise in their current job. Now, there will be some that because of that won't get much raise in 15, 16. Because if that's the year, if the coming year is the year we do the adjustments, they won't get much raise. But looking back at some of them individually, just to test my theory, they got what I call short raises before. They got a raise because we were doing them all in July, even though they didn't have a year in yet. So we might have to remind them of that if we do that. But as you can see on the very last page of my spreadsheet, the approximate savings for 15, 16, the very first year, is $26,000, and then $29,000 in 16, 17, 16 in 17, 18, and 26 in 18, 19. And that's using the current people that we have. So it's a substantial difference. But the way you phase it in is it really hurts no one at any given time, and it also gives them the incentive, not next year, but in 16, 17, it gives them incentive to do above average job and be rated that way because they can get extra money that way. And as you can see, we still save money. Even if everybody, all 60 people got 3% raises, we still save money because we are staggering the impact to us, which was the benefit we originally talked about. So I recommend that we give serious consideration to doing this and setting it up this way. And I tried to cover everything that I could think of in the little packet that you have, and that so, you know, to give you an example, city manager, if I can use Wayne's salary, Wayne's maximum salary under our current pay system would be $96,000. He's in his second year, he's been here a year now, so Wayne is in his second year, he can get a full 2% if the board chose. He's a little different, but because he's board-driven, but the bottom line is that when he got to 96,000, that's how much he's gonna make. If I'm in a grade 5 position under the current pay system, I can only make $50,000 a year, or I can make $50,000. Sizable amount of money. But I could make $50,000 a year. If I wanted to make $75,000 a year, I gotta get a higher job. I gotta work toward it.
I guess my only question is, and I'm for it, I don't see anything there I'm not for. The only question I have is during the, a person's initial year, would this just wipe out the entire probationary system that's in the HR manual currently? There wouldn't be a 6-month and then a year, it would just be based on a year, and we kind of, I guess my question would be, would there be a probationary period still, or would it be?
Well, we could put that in there. You know, I did not. I assumed that the 6 months probation would still be there, but at the end of probation, your benefit is you come off of probation and you get the other benefits that we have.
Right.
Like we start paying retirement and other stuff like that. So I thought that, you know, just keep it to a year, but we could, I mean, it's easily put in there that you can get, you know, a small raise or half the raise at 6 months and the other half in your first year. I mean, it's whatever people want. I'm not married.
Okay.
And I think I'm sorry, I think we talked about that once before. You know, every place that I've worked with and reviewed is, you know, your probationary period, kind of like he said, your reward for that is you get to keep your job. You've shown that you can, you know, you're a valued employee, you're stepping up, you're doing what needs to be done in this role. That's kind of your reward. You get the benefits to start, you get that sort of thing. And so you keep your probationary period as is and work towards that raise at the end of the year on your anniversary date. You know, and if you're outstanding, you get promoted, great, but leave the probationary period as is with no raise at the end of that. Work towards your year anniversary raise.
I didn't give a lot of thought to it because I know we do 6 months, but for me, the federal government's a year probation, and the police department's a year's probation, and so fire department's a year's probation. So I just really didn't. You know, so, but it's whatever the rest of the board wants. I'm not married to it. You know, you're not going to hear me argue over any of this stuff. I do think that I liked what y'all said about having a better than, you know, somebody that's better than average being rewarded. And this does let us afford that. You know, I also looked at part of the, you know, we would have to explain it to everybody, and there's not a lot of impact. A lot of our people don't have a lot of year service. So, you know, it's going to be a couple of years they have to plan before that. And it also gives us a little more breathing room in terms of the health insurance and all that stuff. So I was kind of looking at them as a companion piece, though not necessarily tied to one another. Trying to create a little...
Great work. Appreciate it.
So I don't know what the proper thing to do here is to whether to as a group, to vote on this one, and then I can present it, or Brian, you can present it to the board
I think both of these can be presented during the budget process.
as part of the, okay.
That's part of the process, yeah.
Okay.
Yeah, I agree.
I don't have any trouble with that. I'll just keep my folders.
Yep, I agree.
Due to time constraints, I'd like to make a motion that we I'm not necessarily defer for this meeting, but I would like for the committee members to look over the proposal from Cumberland Securities, and I would like to talk to him within the next week or two. And but my main concern is the variable rate on this building, and that's my main concern. Now, we can probably save a little if we put in, but to be honest, most of our rest of our debt is short term, and we're not going to save a whole lot of money. But if rates do go up on this building, I think substantial loss could be met. So I'd like to propose that we defer or not really discuss this item right now, and I will just email everyone, and we can discuss it through email, what your ideas are on it. And
Tom, do you know how many years we have? Because I can't really tell from this.
it's 10 on this building.
We have 10 years
It's
left.
2026.
We have 10 years left on this building. And we pay an interest rate of?
Was variable, so it's right now it's low.
Right.
Like we're averaging between 1,500 and 1,800 a month.
Okay. And so the balance due on this building,
1.285 million.
so what will we figure this building appraises for?
Well, that's a good question. If we paid 2 million, I would say it's, your guess is as good as mine.
Well, here's what I'm thinking, and don't everybody jump up and scream at me at one time here, but just some thoughts. If we're going to get a fixed interest rate over the next 10 years, and assuming it will be somewhere around whatever fixed interest rates are out there right now, which is what, about 3%?
Well, according to him, it's 1.9.
Okay,
On his.
1.9%. And we're planning in beginning in July 1st, put $360,000 a year up. So we already pay how much per year on this building?
It's over $100,000. We have about 81,000 in principal, and then 1,500 to 1,800 a month.
So if we could borrow some of the equity out of the building and use that money to go ahead and replenish those funds so that we didn't have to put $360,000 per year, if our payment for the next 10 years at 1.9% was less than $460,000, aren't we to the good to do that? We haven't extended the payment, we have replenished the funds, and we've improved our cash flow position.
I think we need to discuss it and think about it. And I'm not sure. I'm not sure how his. I know it would be another note. I'm not sure how that would set up. I don't see why you couldn't. I don't have anything.
If you were, my concern is I don't want to extend the due date. But we're looking right now at a capital outlay of replenishing the fund of 360 and 100,000 on top of that to pay for the building. So, and if all we're paying is 100,000, we can't owe 1.2 million because 100,000 times 10 is only going to be $1 million. So one of those figures is not right. So whatever it is, either we got to pay more.
Well, the principal, yeah, it jumps every year.
Every year. So so if we borrowed $800,000 worth of equity, left the note at 10 years at a fixed rate, and the payment was less than $406,000, we've improved our cash flow. We have already gone ahead and put all the funds current so that we're on the cash basis that everybody talks about. And we have the fixed interest rate with no longer period of time. All we've done is move money from real estate equity to cash equity, which seems to be more comforting to people. So I think we ought to consider that. That's the proposal that I think he can offer us with. I don't want to touch the short-term debt. But I think, just like you, that our problem is our variable debt with this building. If the interest rates go zoom, and if we can get a fixed rate and fix our reserve problem at the same time, it gives people a higher level of comfort with how the books are set. I don't see any problem with that, as long as we don't extend it. I don't want to go out and borrow for 15 years or, you know, do some of this crazy stuff people sometimes do with their personal houses. I'm not talking about doing that. But if the numbers will work the other way, then I think we ought to consider it. Because it would seem to would relieve, and then the budget process would become a cash. If the revenue says we're going to have $5 million, then that's what we have to spend. And we don't have to worry about that. Just a thought. You want me to email you all that, or you get it? Sorry.
Get it, you can email it, and I think it needs to be discussed
We can
further.
move that forward.
Yeah.
Your email discussions?
Yeah.
Everybody agree? Okay.
Great.
All right, 7 was any new business? I didn't see anybody got anything that we weren't aware of? Nope. All right, citizens' comments, limited to the first 5, 3 minutes each. Anybody sign up to speak? No? Okay.
Shannon, anything?
No?
Patty, Sue, Tony? Anything else?
All right.
To adjourn?
Thank y'all for meeting tonight.
In favor? We're done.
Aye.